How is an SDI different from a corporate bond? What protections do I have in case of default? How should I compare the two options? This is all so confusing. These were some of the questions from our viewers after our explainer video on SDIs last week. And I completely understand the confusion. Hey there, I'm Yash Roongta, the founder of ALT Investor, India's first and largest community on alternative investments. And I welcome you to AltXtra series powered by Grip Invest. With AltXtra, we are decoding the complexities of high yield investments to help you make smarter investment choices. In today's video, we'll explore the collapse of Diwan Housing Finance Limited, popularly known as DHFL, and how it affected both its bondholders and SDI investors. This example will highlight the key differences between bonds and SDIs, helping you decide which investment option is right for you. Just as a recap, SDIs are securitized debt instruments, which are financial products where banks and NBFCs bundle various loans together into a single package and sell this package to retail investors for as low as 1 lakh rupees. So let's dive in. For those unfamiliar, DHFL was founded in 1984 by the Diwan family to provide affordable housing finance for lower and middle income groups. To give out housing loans, DHFL needed to raise funds. And as a deposit-taking housing finance company, they did this by issuing corporate bonds, commercial papers, fixed deposits, and also by securitizing their housing loans into a residential mortgage-backed security, also known as RMBS. Think of RMBS as SDIs backed by a pool of home loans with a tenure of around 10 to 15 years. Everything was smooth sailing for DHFL until 2018. In mid-2019, they faced an asset liability mismatch crisis. Now, what is asset liability mismatch? It occurs when the duration of liabilities, long-term home loans, doesn't match the duration of assets. For example, DHFL issued home loans for 15 to 20 years but raised funds through bonds and commercial papers for only, let's say, 5 to 6 years. This mismatch meant if DHFL couldn't raise more funds in 5 to 6 years, they faced a risk. Interestingly, asset liability mismatch was also the reason behind the Silicon Valley Bank collapse in the US. In 2019, DHFL couldn't meet its short-term repayment obligations, and CRISIL, the rating agency, downgraded their commercial paper rating from A4 plus to D, indicating default. This alarmed both the bond and SDI holders. CRISIL even downgraded the SDI from AAA in 2018 to just B plus in 2019 and eventually to D in 2020. The market sentiment was bleak. People were thinking, ye paisa to gaya. But let's think fundamentally. The housing loans in the SDI pool actually didn't default. Borrowers जिन्होंने पैसा उठाया था continued to pay their EMIs, and that money reached the securitization trust, eventually being paid back to the SDI holders. Even if some borrowers defaulted, the credit enhancements and collateral in the pools covered the investors. So no SDI investor faced even a single rupee loss. They continued to receive what was promised to them. CRISIL noticed a 99.9% cumulative collection ratio and upgraded the SDI rating from D to AA in 2023. As of today, the SDI still has about 9 to 10 years worth of tenure left and will continue paying investors as expected. On the other hand, DHFL went into bankruptcy proceedings, and those holding bonds or fixed deposits or commercial papers recovered only about 46% of their initial investment. For example, आपने अगर 1 लाख रुपए डाला था, you are only able to get back 46,000 rupees. Forget the interest overall. Are you wondering what happened to DHFL though? Well, in 2021, DHFL was acquired by Piramal Housing Finance Limited. So tell me, what did we learn about the differences between SDIs and corporate bonds from this example? Well, it shows that even if the issuer defaults, which is DHFL in this case, the housing loans securitized off the books remain unaffected thanks to a feature called bankruptcy remoteness. As long as the borrowers keep paying their EMIs, SDIs will not default, a luxury that the bondholders or fixed deposit holders didn't have. I hope you find this case study insightful. To be clear, both bonds and SDIs serve different purposes in the economy. We will compare SDIs, bonds and FDs in our next video. But that's it for this one. Tell us, were you one of the bond or SDI investors in DHFL? Let us know in the comments. Stay tuned for more insights from AltXtra, powered by Alt Investor and Grip Invest. Don't forget to like, share and subscribe if you found this video useful. Happy investing!
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.